Broadcasting.
There you go.
Experience.
Oh, we're ready to roll. Good morning, everyone. I am calling today's meeting to order at 11:01 a.m. on June 16th, 2026. Thank you all for attending, and we are welcoming committee members in person and remotely via video conference. Also to the public viewing today, thank you for joining us. Please note this meeting is being videotaped. A link to the video will be posted on the Olympic Authority website following this meeting. As we start with today's items, I will remind committee members to please speak as clearly as possible and to identify yourselves each time you speak or make a motion. An agenda is included in your packet, and we will have Renee call the roll.
Billy Jones,
Here.
Bill Beanie, Jen Holdering.
Here.
Joe Martens.
Here.
Eleanor Tatum. Here. And Joe Zalewski.
Here.
We have a quorum.
A quorum is present. So now we have approval of the previous minutes. May I have a motion approving the minutes of our last meeting held on September 19th, 2025?
So moved.
Eleanor makes a motion. Can I have a second?
I'll second. Joe Martens.
Joe Martens seconds. Is there any discussion? All approve?
Aye.
Aye.
Any
Aye.
nays? Eleanor, any nays? Motion of the approval of the previous minutes passes.
Extensions too.
Oh, abstentions. Thank you, Mr. Chair. Any abstentions?
No.
No. Approval of previous minutes is passed. Now we have the item on the agenda. Yes, the independent auditor's report is next.
All right, thank you.
Do you want me to introduce you or?
I can introduce.
Okay. All right.
My name is Tom Smith. I was the partner on this engagement, and we put together a presentation which we're going to put on the screen, and I'm going to go through that. Sure.
Okay. Apologize. There we go. Whoop. Let's go with this.
All right, so on today's agenda, we're going to go through our team with the time years. So we're going to go through all the financial results for the year ended March 31st, 2026, as well as some of the required communications to the audit committee. So this is a summary of the engagement team. We did have a few other individuals work on the engagement, but I always feel it's beneficial for you to see some of the faces that go into the audit, because a lot of times there's a lot more people that are working in the background. You really only see me during the meetings, but Dave Greck's been working on the engagement for a number of years, as well as Mindy Fisk, who does represent our MWB portion of the contract. Timing of our procedures, we were on site in April. We were able to get the draft of the financial statements out on June 3rd, and we're meeting with you today. The audit results, we are anticipating issuing what's called a clean or unmodified opinion on these financial statements as well as the investment report. What that means is that's the highest level of assurance that we can give on the financial statements, meaning that everything in here has been supported, the footnotes, the numbers, everything is clean. And I really want to thank management for their cooperation through the audit. We worked with Ron Graham throughout, and it made the audit go extremely smoothly. So I really want to point that out when that does happen. As part of any government type of engagement, we do have to look at your internal controls and any compliance with laws and regulations. If we find any weaknesses or material non-compliance, we do have to report that to you, the audit committee. But I am glad to say that we did not come across anything of that nature, so that report will be also clean, unmodified as well. So a few of the financial results as of March 31st, 2026. Your overall net position, that's the difference between your assets and your liabilities or your equity, was $588.2 million. Looking as a comparison of the prior year, that number was $480 million. Your capital assets, essentially your infrastructure, everything that you put into the ground, amounted to $622.9 million. That is a increase over the prior year. That number was $520 million. So you can see that number is going up. Your current assets, which really represent your any type of inventory, cash and equivalents, or receivables amounts owed from any other entities, was $55 million in the current year. And that's compared to $53 million in the prior year. So we can see some good trends going on there. Net pension liability. What this is you have to pick up a proportionate share of the New York State pension liability. They control all of that accounting, and at year end, they give out a report to every entity that is a participant, and you have to pick up your proportionate share. If New York State was to go out of business, then that's the only way that liability becomes your liability. But you'll see that that amounted to just under $16 million at year end. So we do have to put this on your financial statements, even though this is not a number you're going to receive any type of invoice for. So it looks like a large number, but you will just pay your annual contributions every year. And you can see your total liabilities are just under 90 million at year end compared to 76.7. And we did provide a breakout of the material numbers in there. And you're going to see right at the top, other post-employment benefits at 51.4 million. What that represents is our projection of long-term health insurance. Under Government Accounting Standards Board, or GASB, what they did a few years ago, about 10 years ago, is they wanted to align more with a private type entity, or they follow FASB. That's their set of accounting standards. So FASB required private companies, IBM, Apple, to put on long-term liabilities, projecting this out. Now, this is the number you have to hire an actuary for to say, if ORDA went out of business tomorrow, what would our potential exposure be to retirees for their health insurance? So this is a number that we're going to be paying any type of liability for, but we just make our annual contributions every year. They want to see what could be the potential net impact. And this number can change by tens of millions of dollars every year based on actuarial assumptions. There's actually a schedule in the financial statements that is a required statement under GASB. And we do have to show for the past 10 years how that number has changed. And you're going to see from the prior year, that number jumped by $12 million. And it's all due to actuarial assumptions. So you can see that is not a number we're actually paying out. It's just an estimate, and it changes vastly every year. So more of the financial results, we'll see that our net position is 107.5 in the current year and 36.6 million, so the change in. Not your operating, you did have an operating loss, that's just your operating income and expenses, but you also do have a large amount of non-operating items. That's where really the money from New York State flows through. So you're gonna see, you really have to look at it as they offset. So you're gonna see non-operating income of 12.3 million and capital contributions, which is New York State money, of 147.7 million. So you really do have to look at all those buckets in the aggregate. And your cash flows, there's just your change from year to year. You did have an overall decrease in your cash balances at year end compared to the prior year of 3.4 million. And those do fall under different type of buckets, just like the operating and non-operating income and loss. So you can see where those numbers are coming from, operations, non-capital. And as we have changes in our receivables and payables from year to year, those numbers are going to fluctuate. So we did have some decreases from accounts receivable and payables, and that's really because we were able to provide services for that drives up our accounts receivable. We just haven't collected it by year end. And the same thing with accounts payable. We had expenses to vendors and we paid out more money in actual cash in the current year. So that's why that reflects some increases and decreases. Some of the significant items that we have to disclose to the audit committee that you're aware of in these financial statements are some of the significant footnotes. Footnote 1 describes your accounting policies. Typically, those don't change year over year unless there's a new standard that we have to implement. Note 2, we detailed the investments of the authority. And note 8 and 10 is where we describe the pensions and that OPEB liability. And 8 and 10 are quite lengthy because we have to disclose all the actual assumptions, as well as there's a piece of that where we show the sensitivity to those assumptions. So if a discount rate was to increase or decrease, we have to show if the actuary used a different discount rate, how much that could actually affect these financial statements by. And just to show you an example of that, for the OPEB footnote, which is note 10 to your financial statements, if we use a discount rate that was 1% lower, we would actually have a $7 million higher liability for that number. And vice versa, if we went 1 percentage point higher, it's going to change it into a positive direction. So it just shows why these footnotes are so significant, because they really show the full picture of everything if different assumptions were used. Management letter, this would be if we come across any recommendations, best practices that we note that the authority is not following. We might see another client and we did not come across anything that we felt you needed to be aware of. The operations of the finance department are running extremely smooth. So I think that should just give you some more reassurance of some of the numbers you're receiving throughout the year. Our report to the board are required communications. No new accounting policies in the current year. We do have to look at your estimates. A lot of that would be in your accounts receivable. Are these items collectible? So we do look at those items. We didn't have any difficulties in dealing with management or performing the audit. The last bullet point is we will obtain a management representation letter. Essentially, that's the last piece of documentation before we can issue the financial statements. So overall, I just want to really stress, really clean, successful audit. Everything went extremely smooth. And I really want to open it up to any questions you might have on the presentation, the financial statements, anything, go into more detail.
Okay. Well, thank you very much to EFPR for your presentation and our finance department for all the work they have done as well. And now we'll open it up to any questions or comments on the report.
I had a question.
Jen?
Jen Holdereid, when you're talking about the total net position, went up from 520 to 620. Basically, I was just wondering what is the difference?
The increase year over year. The majority of that is just your revenues exceeded your expenses. The expenses are pretty straightforward to budget for. We know we have operational expenses for payroll, benefits. We have a good sense of what that is coming into the year. But if you do look at the income statement, I'm not sure if you have the financial statements with you.
Yeah.
On page 16, you're going to see your operating revenue. It increased by approximately $7 million from the prior year. And a lot of that is the events and ticket sales. So it really is just your revenue over your expenses.
I think she's talking about this, which would be new assets coming online, correct?
But that would be the revenue over the expenses would increase that line.
All right. Any more questions or comments?
Sure.
Mr. Martin?
Thank you, Mr. Chair. Tom, thank you for the report. So for the last several years, we've had a bit of a media focus on our net operating loss, or our operating losses. You note, I think that it went up this year by approximately $2 million over the prior year. Could you go into more detail about what comprises those losses, particularly the depreciation and non-cash aspects of that?
Absolutely. So as part of that operating loss, we do, a large piece of that is depreciation expense. It's a non-cash expense. Essentially, when we put the items outside, the lifts, the buildings, we have to expense that over, typically those are expensed over 40 years. So that's a large piece of what contributes to a loss. That number is just under $36 million this year. So if we took that out, we're down to approximately 26 million, but also there's other aspects in there. Changes in that OPEB, for example, also, and any changes in your pension, because those are considered payroll related, also have to go into that number. So as those liabilities increase, those become recognized as operating expenses, even though it's not cash out the door. So even though we have a $52 million loss, we have very large non-cash expenses that are reflected in these financial statements.
Roughly, if you take out all of the non-cash pieces of that, what percentage would remain, or what percentage all?
Sure, and now you just have to pull up a couple of those expenses. So depreciation is $36 million of expense. We have in pension another 3 million. So we're at approximately 39 million of non-cash. And the last big piece of that is OPEB, which is pretty net zero for this year. Typically it fluctuates. It can be in the multi-millions. So I would say that is 39 to 40 million goes to those non-cash buckets for this year.
Okay. And when you say non-cash, it means it's not something that the authority has to pay for.
Correct.
The state of New York has to pay for.
Correct. We have to reflect an expense, but it is not cash that went out the door.
Got it. Thank you.
Could you explain how you come up with that depreciation number? Like you had mentioned a certain amount of time. How do you get that number?
Sure. So I'm going to use some hypothetical numbers on this. So say if we put all our buildings, we built all our buildings this year and it cost us $40 million. We have to depreciate that over 40 years. We would take $1 million of expense every year for the next 40 years until the net value of that building is zero. So we take the total amount of your capital assets and depreciate it over what's considered the useful life of it. So if we bought, let's say, a car that might get we buy it for $20,000, we're probably going to depreciate that over 5 years, so $4,000 of expense every year on a vehicle. So it depends on which type of asset we are purchasing, and it depends also on the useful life. So a building's going to be depreciated over a much longer period of time.
Okay. And you have a standard to go by to do that?
Sure, absolutely. It's also a management estimate, but we make sure that the lives that they're depreciating over actually make sense. Because if we purchase a vehicle and they want to depreciate over 40 years, that really doesn't make sense because we know that's going to be gone in 5 to 7 years. Whereas a building, if they want to depreciate over 5 years, that doesn't make sense either because we know it's going to be around for quite a bit period of time. So it's one of those items that we make sure that management's estimates are reasonable.
Unless you're purchasing one of those Porsches out there.
And I'm not.
And just one other thing, the cash flow, that's obviously, I mean, expenses going out the door and cash flow coming in, that number is going to fluctuate because that's in real time when you get that. It's not, you have the budget here and then you have cash flow coming in or going out.
Yeah, a lot of times it's a better picture of the financial position because that number only changed by $3 million. When you look at an operating loss that changed by $50-60 million, well, really we only had $3 million net go out the door. So a lot of times that's really a better picture of the financial state of an entity. And again, also, like you said, it's an exact point in time where we might have a $5 million receivable from an entity, but we collect it on April 1st, so it doesn't get reflected here. So sometimes even though some things might look negative, it's actually good that receivables are up because that means we produce more business.
Okay. Any more questions or comments?
So, one more, because this article, having to do with our financial, or our audit financials appeared yesterday, a lot of time to study it, but one of the other, costs that the article notes, and this is an article in the Explorer, it says the authority spent 15.5 million on consulting costs, up from 13.4 million in February. And maybe Ashley, you may want to address this, but I believe the number that the article refers to was not consulting costs, but it was contractual services. What's the difference between contractual services and consultant costs? I think he's conflating two of them here.
Sure. Consulting's really a subcategory of contractual. Contractual can be any payment we make out the door that's not personnel. I mean, you can very easily regroup where we think some things are, but typically your expenses are going to be either personnel or contractual. Consulting is a very specific bucket of contractual. So I can't speak to that 15 million because I'm not exactly sure where that number is coming from. But that might be something management wants to touch on a little bit more detail.
You want to take it, Ron, or?
Yeah, so taking a look at contractual services from the $15 million standpoint.
Come here by the microphone. And there isn't, while Ron's coming here, there is an inaccuracy in this because it does say 13.4, which does not match the financial statements, which is 12.4. So there's an error in the article. We are comparing 15.5 to 12.4.
Good point.
Yeah, so what makes up that 15 million? So the largest part is insurance. Insurance was 4 million. The next piece is credit card fees because we have contracts with the processing companies.
And on that, it should be noted, the more revenue that we bring in, the higher that expense will be. So
Absolutely.
it's all directly related to the amount of revenue coming in for the credit card processing fees.
Yes, so and we moved towards mitten friendly, so that would have increased the credit card fees there as well. So that was roughly $3 million. And then that's where a lot of our software contracts go. So we have a lot of, subscriptions for software, our accounting software, things like that. So that was about 800,000 of the 15. So there's, close to 8 million out of the 15. The rest is different services. So waste management, we have weather services, and probably about 80 other companies that fall under that. So.
Great. Thank you, Ron.
You're welcome.
Ron, just a question on the 4 million for insurance. What insurance is that? Is that liability? Is that?
Yes, property liability as well as, all the different board and all the other types of liability. Yeah.
You have to have it.
Yeah.
And as our insurance cost goes up.
Yes.
Well, insurance costs never goes down.
That's true.
Let's face it.
That's true.
Any other questions or comments? All right. May I have a motion to recommend that the Olympic Authority Board of Directors approve the independent auditor's report and proposed resolution 588? May I get a motion?
So move. This is Joe.
Second.
Second, Eleanor. Any further discussion on the motion or resolution? All in favor?
Aye.
Any opposed? Any abstained? Motion carries. Is there any other items to come before the committee today? All right.
That's it, Mr. Chair.
That was easy. If not, I would like to take a motion to adjourn. Motion to adjourn?
So moved.
Jen, may I get a second?
Second.
Joe? Oh, he beat you to it, Eleanor. All in favor?
Aye.
Aye.
Any opposed? Any abstained? The meeting is adjourned at 11:25 on June 16th. Thank you, everyone. Thank you for your work.